There seems to be quite a bit of confusion when it comes to retirement accounts, so hopefully I can clear things up a bit. In general, retirement accounts are tax advantaged, meaning they are either exempt from taxes, allow you to postpone tax payments, which is also called a tax deferral, or they provide other tax benefits. In this video, I'll talk about retirement accounts that are offered by employers called pension plans. Now, many of us misinterpret a pension plan as a fixed income that a retiree receives from their former employer. Well, that's not exactly it. Pensions are distributions from retirement accounts that you may or may not have control of depending on which type of plan you have. The two types of pension plans are defined benefit plans and defined contribution plans. For defined benefit plans, the company you retired from pays a fixed amount regularly throughout your retirement that is taxable, which is a form of tax deferral. Commonly, employers pay retired employees their final salary multiplied by the length of employment multiplied by a specific percentage called the accrual rate. Hence the term defined benefit, because the benefit is defined by your salary, length of employment, and a percentage of that amount. For example, suppose you worked at a company for 20 years, earning $100,000 the year you retired and were to have a 1% accrual rate. Your defined benefit, or pension as most people call it, would be an annual payment of 20 times $100,000 times 1%, which is $20,000 per year. So you know, there are several other calculations that may be used for a defined benefit plan, but just to make it clear, I describe the simplest one. Companies who offer defined benefit plans are obligated to pay their retired employees and manage the funds directly, or they can hire a pension manager. There are a few other problems as well. For one, benefit plan investments must have enough liquidity to be prepared for paying retiring employees, which can occur anytime. Second, employers need to actively manage the investments in the plan, which may be easy for financial institutions, but more difficult for companies that are not, such as a shoe manufacturer. For defined contribution plans, rather than having the company account contribute all of the money to pay you throughout retirement, you and possibly your employer will contribute to your personal account, which will pay distributions, which can also be called a withdrawal, during retirement. Employees cannot contribute more than the limit the IRS set for the plan you're using. For example, the contribution limit for a 401k in 2015 is $18,000 for people younger than 50 and $24,000 for those who are 50 or older. There are several other types of defined contribution plans, such as the 403b, Money Purchase Pension Plan, also known as MPPP, Profit Sharing Plan, Stock Bonus Plans, and Employee Stock Ownership Plan, also known as ESOP. Now, taxes on contributions and distributions from your defined contribution plan are dependent on the plan your employer offers. Either way, the contributions sit in your account to be invested by your administrator. Once you're over 59.5 years old, you will be eligible to receive distributions from your plan. If you withdraw prior to that, you will have to pay an early withdrawal fee unless your withdrawal fits certain criteria. The next significant age is 70.5, when you have a required minimum withdrawal. If you do not withdraw the minimum required amount, you may have to pay a 50% tax on that amount. So please be aware there are a few exceptions to these general rules. However, they do affect the majority of accounts. One of the greatest benefits from having a pension plan is the fact that you don't need to pay capital gains and possibly income taxes on contributions and investments until you make a withdrawal. Additionally, if you are in a lower tax bracket at the time of withdrawal, you also benefit from paying less in taxes. Well, I hope you enjoyed this lesson. Take care.